Welcome to The Business That Pays with Adam Tolliver from Artisan Financial Strategies, where we mind the business that pays you. In this podcast, we empower successful families and business owners to make informed decisions about their finances through courageous conversations. Through his expertise as a practicing investment advisor representative with Eagle Strategies, LLC, a registered investment advisor, Adam teaches you how to create a wealth ecosystem by combining a practical technical framework with your personal, family, and community values. Join us for this journey where Adam normalizes sustainable wealth building and gives you the keys to make courageous, proactive financial decisions.
The key question for this episode of The Business That Pays:
are we our portfolio's own worst enemy?
That is Adam Tolliver, the host and the brains behind this podcast. I'm Patrice Sikora. You may not be aware of the factors that influence how you think about investing or risk, or how you judge success or failure when growing your money. That is all part of behavioral finance. Now, Adam, why don't you tell us more about this area of study?
Sure thing. So, behavioral finance is the area of planning that examines how our human emotions and biases lead to some incorrect assumptions and conclusions we may draw when we're examining or making a financial decision.
Now, you say there's a wide range of these biases to be considered, and you want to talk about 5 of them in particular today, right?
Yes, there are dozens and dozens. And quite frankly, when you're reading about them, you're going to, if you're out doing your own research, you'll notice some overlap and some relatability between several because they tend to sort of compound on each other. But these 5, I think, do a really good job of capturing just how we may get in our own way when we're looking at our own investments and financial decisions.
The first one you call loss aversion. And with all the volatility in the markets lately, I can see how this may have been playing a huge role in how people feel. But tell us about this loss aversion.
Yes, loss aversion is a very interesting one because I think logically we can all agree that it's very reasonable not to want to lose something.
Mhm.
But loss aversion is a little bit more complex than that, in that it's not just that you don't want to lose something, it's the tendency for us to weigh the loss of something more heavily than we would making a gain of similar value.
So, in other words, we feel sorrow more than we feel the happiness?
That's correct. So the joy of potentially gaining something that we did not have is a little bit less less enjoyable than the pain and suffering of losing something that we already have. A great example of this that's often used to illustrate the idea of loss aversion is a bottle of wine. So let's say you're gifted an expensive bottle of wine, it's $1,000. Of course, you're really happy, grateful for that.
And I'm ready to open it too.
Absolutely, especially if you're a wine drinker, right? So that's a great thing. But the idea is that on the flip side, if you had already owned that $1,000 bottle of wine and it were dropped and shattered, your reaction to that loss of the wine would be stronger than your joy of the gain of it. And a lot of that has to do with attachments to things we possess. And one of the other biases that we'll talk about later speaks directly to that. And then it's also sort of the fear of feeling like you squandered something valuable. So you feel careless, you feel like you have bad luck. And from an outside looking in thing, you may even fear like, people look at this klutz, like what, you can't even, like you don't take care of good things. You know what I mean? So like feeling like you're foolish or you've lost something of value.
All right. Now, but how does this translate into our portfolios?
Well, in our portfolio, of course, this is our money. So it's one of the tangible ways that we measure and grow our wealth. And so a lot of the times what it'll do is have an impact on the risk we're willing to take for the necessary gains to reach our long-term goals. And that can impact the decisions that we make in the short term that ultimately play out in a negative way for us in the long term.
Have you seen a lot of that lately with the market all over the place?
It depends. I am very, very pleased that I believe at Artisan, we do a wonderful job with our clients of setting expectations and preparing them. We talk about those 4 pillars that we
Right.
talked about in our previous series of episodes. And a lot of that is meant to help regulate our expectations, our emotions, and our behaviors to do our best to mitigate and protect ourselves from ourselves, because ultimately, that's really a lot of what this is about. The technical aspects of planning are going to be what they're going to be, but ultimately, we have to regulate our own behavior in order to get the outcomes that we want. And fortunately, when things do go a little wonky from day to day, we've done a great job of coaching our clients to be prepared and understand that we're looking at long term here. And in the event that we do have a shorter time horizon and say you are relying on your portfolio right now, we also like to strategize and make sure that we've got other options to go to so that you don't have to put so much of an emotional burden on that particular asset.
Okay. Now, this next one, sunk cost fallacy. I don't know. It sounds like either a pirate video game or, or something else here. Talk about wonky. Explain this one, please.
Yes, sunk cost fallacy. So, how many times have you kind of followed through with something that you didn't really want to do because you had already spent money or energy or time trying to make it happen?
Oh, yeah. Oh, yeah. No argument there.
So, sunk cost fallacy is about our tendency to throw additional resources behind something that we kind of realize is not working out very well. But because we've already invested money or time or energy, whatever resource into it, we feel as though we can justify investing more because what we've already invested will be lost if we don't. That's the sunk cost.
Okay.
We've already sunk cost into this project, this investment, this endeavor. So if we don't see it through to completion, then we've wasted our money.
Oh, but wait, Adam, we put all this money and this effort and this time into it, and it's going to come back, right? It's going to come roaring back.
That is often the hope. That is often the hope.
No.
And very frequently, that is not going to be the outcome. And so this is just our minds trying to justify the behavior that we've already committed to. We've already invested, we've already committed. And so we don't want that to go to waste, quote unquote. When reality, if we're sinking more investments, more commitment, then we're just making more waste.
How do you convince people to cut their losses?
Ooh, it is not easy.
Yeah, I'm sure.
That one is not easy because, again, we are dealing with emotion. So you kind of have to remind people. And that's one good thing about behavioral finance. It's generally speaking, no one is immune to any of these biases. These are cognitive biases. This is the way that we behave, right? But once we're aware of them and we can speak to them, we're able to recognize when we may be doing it. And part of my job, and really any planner or advisor's job, is to be an accountability partner and an outside eye looking in who's not directly invested, right? So it's not my skin in the game necessarily,
Mm.
but it's my job. You pay me to be an objective outside eye, right? And so, tensions can get,
Mm-hmm.
it happens.
Yeah.
These are emotional conversations we're talking about. Sometimes this might not even be an investment portfolio. It could be a house. I'm not a marriage counselor, but people have sunk cost fallacy issues in relationships. And so making a decision oftentimes requires an outside eye who's not as invested in a lot of the past commitment and baggage that comes with an investment or a project or an endeavor.
That's a good point. It's more than just finance, but let's stick to the finance now because, boy, as you say, neither of us are
Yes,
marriage counselors here.
absolutely.
Um, do
We will
people,
steer clear.
that's all right. Do people learn from this, or have you seen people repeat the cycle again and again?
It fluctuates just like any other lesson learned. It's never really linear. Well, that's not fair. There are definitely some people who are like, "Oh, I see it, I get it, I got it," right?
Okay.
But it's totally normal to fall susceptible to something more than once just because that's, again, we're talking about human beings, human emotions, human biases. And so we'll actually talk about another bias coming up here shortly after this next one that speaks to that issue.
Okay. Right. Well, then let's get to the next one here. You call it the endowment effect. Tell me about this.
Yes. So the endowment effect, and you'll sort of notice some similarity here between the loss aversion effect, but this is about our tendency to value something more highly once we own it.
Oh, but that means I've made the right decision. I own it, right?
Exactly. You
Yeah.
want to validate the decision that you've already made. You've developed some comfort with what you already have. And so this is really about this thing is in my possession, and the idea of giving it up, even for something that's of equal or similar value, feels like I'm losing something.
Hmm.
And so this can come up in all sorts of financial decision making, selling a property, selling stock, selling any other item of value. And then it also may come up in just a even trade. So one experiment that they used to focus on the endowment effect was at the beginning of a class, they gave everyone a coffee mug or a chocolate bar. And at the end of the class, they gave them the opportunity to swap them out. And everyone was most likely to keep what they had been given in the first place, which, and that's despite what their initial preference might have been, because they started to value the thing that they were given and had in their possession more than the opposite option.
All right, I have to admit, I have felt this when I had a stock
Hmm.
and my financial advisor said, we could sell this and do this and this. I'm thinking, no, but that's my stock. I
Yeah.
bought that I made that decision and it was
Hmm.
hard. It was hard to do it.
Yeah.
I resented his suggestion there. Yeah, I can see that this would be an issue. And when you come up with property, not just stock, you're talking about
Oh,
some
it
physical.
gets
Yeah,
very sticky. It gets very, if we're talking about a home
yeah.
or a car, or, and this to go even several layers deep, a lot of times the things that people fight about in estates and things like that aren't things that have financial value, they're things that have emotional value.
Good
And
point.
so, it might be the tricycle that dad left behind from his childhood, some old family heirloom, something that you can't really sell somewhere else, but it becomes sort of a token or avatar for the love of the person who's passed, right? And so people fight over things just based on their emotional connection. So if you think about a home that probably would be better off if it were sold in some scenario,
Mhm.
but because of the memories and the experiences and everything tied to the property, someone might hold on to it just for that reason.
Yep. Yep. All right, another confession here. I'm looking at a broken temp scribe little knickknack that my father had. He has since passed, and I took it. It's not even
Hmm.
complete. It's part of it is broken, but I took it thinking, I can take care of this. I can fix this. And I'm looking at it going, why do I have this?
Uh-huh.
Why did I take this? And hopefully, eventually, emotionally, I will be able to say, go away, be free in the garbage.
Hmm. Yeah, that's a big endowment effect is one of those things that comes up a lot with hoarders as well.
Oh, that's a good point.
Yeah, so you sort of just start to really convince yourself that there's some value existing here, even if you're never going to use this little knickknack or whatever it might be. It may just be collecting dust, but the moment someone tries to throw it away, you're like, "What are you doing?" You know what I mean? So
Yeah. All right. It's going out tomorrow. I'll tell you that right now. It's going out tomorrow.
I believe in you.
Check up on me the next time we talk. Okay.
I got you.
All right. Now, familiarity bias. You were saying this is the next bias we have to watch out for?
Yes, this is our preference to remain confined to what is familiar to us. I think that this is probably one of the most relatable. We enjoy our comfort zones. That's why they're called comfort zones. So we tend to buy the same brands when we go to the grocery store.
Hmm.
We tend to order the same meals at our favorite restaurants, even if something else may seem appealing. We sort of have our old faithful. Of course, some people are a lot more adventurous than others, but generally speaking, when we walk into a room full of people, we're scanning the room initially to look for some familiar faces. We like familiarity, right?
Yeah.
And so when it comes to investing, it can do a couple of things. One, it can lead to us sort of shying away from one option towards another, in doing so despite the merit or profitability of the two items compared to each other. And so, just for an example, if we're looking at comparing shares of Amazon to shares of another lesser known company, more often people are going to choose Amazon without doing any sort of in depth fundamental analysis of the profitability on the other company because they know and recognize Amazon. And that's not to say that that's always the wrong decision,
Right.
but you close yourself off from the possibility of looking at and evaluating another profitable option that could be more profitable for you depending on your situation.
How do you find this in your practice?
Typically, what we're doing when we make recommendations, let's say we've got a list of different investment managers and solutions that we're presenting to a client, people tend to perk up when they hear names like Fidelity or BlackRock or Vanguard because they're familiar with them.
Right.
They've seen the commercials. A lot of their 401ks may have already been invested in these types of companies. And of course, to be clear, these are wonderful companies. But if I were to name a lesser known to the public investment manager who may be a wonderful performer for the various reasons that we pick and choose an investment manager, they may need a little bit more education before they come along. It might just be a lot easier to convince them if we name one of those more familiar money managers.
Do you try to convince your clients that they should at least consider these other names? Do you have research for them to look at?
Yes. So by the time we get to recommendations in our process, our clients have gone through 3 meetings that are education focused. So we talk about the technical aspects of planning as well as our philosophy and approach to the different areas of planning, including investment management. When we present an investment manager and one of their funds or a solution, we are talking to them about the people that work at the company. We're talking to them about the performance. We're talking to them about their policy. So, how do they approach? And then we're assuring them that if at some point any of these things were out of line with what we felt was best for you, we have the ability to pivot so we can change. But, providing the information, making sure that clients understand the reasoning, like why are we doing these things, it goes a long way.
Do you see any difference in the age of your clients when it comes to being stuck with a name? It's so familiar to them, they don't want to look at anything else. I'm thinking basically, are younger people more open to new names?
That's a good question. I'm not really sure. My experience has been, again, just based on our process, that they're open. But generally speaking, if it's one of those more well-known names, it's just a lot quicker of
Mm.
they're able to make the association very quickly. They're like, yes, you know what I mean? Like I'm comfortable with that. With anything else, of course, naturally they're, tell me more. I need to get a little bit more. And that's been pretty consistent regardless of age for me.
Okay. All right. Now, this last one, number 5, the bandwagon effect. Oh boy. In this day and
Mhm.
age, this to me jumps out like a sore thumb. Here we are. This is it. Social proof, social media, bandwagon. Everybody wants to do it. Tell me.
Just like the name implies, jumping on the bandwagon. This is literally our tendency to do something primarily because other people are doing it. So when your mom asks if you jump off a bridge just because your friends were doing it, the answer is actually yes, sometimes. It is our tendency to align ourselves with the group. And this is also called herd mentality. So we don't want to feel left out. Again, going back to the idea of loss, we don't want to feel like we've lost something in comparison to what other people like us are gaining. So this is one of those things that can be really, really easily identified and pronounced when it comes to investing. Because when more people jump on a bandwagon, the price of an asset will continue to rise. And this will start a sort of positive feedback loop between the price and the demand. The price is going up. Everybody's like, what do people know that I don't know? It doesn't matter. I'm going to jump on to make sure that I don't miss out. Right. So even without fully understanding the underlying asset, the value, it must be something because if it wasn't, why would all these people be doing it?
And this just brings to mind the GameStop situation and Robinhood.
Yes. That's a wonderful example. And this is how bubbles are made. Basically, when the price and the demand of an asset rise and rise and rise without any sort of underlying justification for the increase in value, eventually that's going to fall. And so,
And it's not just investments in stock or equities, it's homes.
mhm,
It's
yes,
we had the housing bubble.
housing bubble, student loan bubble, bubbles everywhere.
And
So,
how do you stay away from those?
well, you've just got to be mindful. And a lot of it really depends on, when we set out with a strategy for a client, we have established parameters based on the goals and objectives. A lot of the times, what we want to do is build in some flexibility so that for peace of mind, a client can have the space with a small corner of their money to take a flyer on some random opportunity that they
Hmm.
think. And it's not to quote unquote appease, but what we want to do is say, hey, this pile of money over here is your nest egg. It's your serious money. It's not your play money. This is the money that you're going to rely on for your income when you get older. This is the money that's going to put your children through college. You know what I mean?
Right.
We don't want to take any unnecessary risk with this money. When the resources are available, they may have enough room or income or assets to have a smaller piece of the pie that they can say, hey, I'm really interested in this nondescript generic cryptocurrency over here. Something's telling me it's going to take off.
Good for them.
Right. And so there's a possibility that they can make a sizable profit in a short amount of time by doing that. But as far as a long term strategy that fits into your plan, we don't want you to bank your plan on something like that. So you got to kind of give a little bit of flexibility to allow for that option.
Adam, how can people reach you if they want to talk more about loss aversion, sunk cost fallacy, endowment effect, familiarity bias, the bandwagon effect, any other questions they've got about investing and finances and their plan? How can they reach you?
You can reach me at workingwithadam.com. I'll be more than happy to sit down and chat with you.
And listeners, please subscribe to Adam's podcast, The Business That Pays. You will know when new episodes are released. And you're also encouraged to share with others, and please like this podcast. I'm Patrice Sikora, and let's talk again later.
Thank you for listening to Business That Pays. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of the Artisan Financial Strategies or Eagle Strategies, LLC, a registered investment advisor. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial professional provider with any questions you may have regarding your investment strategies.
Adam Tolliver, registered representative offering securities through New York Life Securities, LLC, member FINRA SIPC, a licensed insurance agency. 1125 Cambridge Square, Suite C, Alpharetta, Georgia, 30009, 404-210-9311. Financial advisor offering investment advisory services through Eagle Strategies, LLC, a registered investment advisor. New York Life Securities, LLC, and Eagle Strategies, LLC are New York Life companies. Artisan Financial Strategies, LLC is not owned or operated by New York Life Securities, LLC, or its affiliates. Neither Artisan Financial Strategies, LLC, nor its advisors provide tax, legal, or accounting advice.